Hello. In today's video, we talk about significant economic shifts that could have substantial repercussions for the United States. We will examine the reasons behind Japan, China, and even the U.S. Federal Reserve's diminished interest in purchasing Treasury bonds and its implications for America's economic landscape. Additionally, we will elucidate intricate concepts such as quantitative easing and quantitative tightening to enhance our comprehension of their market effects. Furthermore, we will explore BRICS and their initiative to establish an alternative to the US dollar as the world's reserve currency. To commence, let us elucidate the paramount significance of US Treasury bonds. The United States government issues Treasury bonds as a means of raising capital. When an individual purchases a Treasury bond, they are essentially lending money to the US government, which pledges to repay the principal amount with interest at a predetermined date. Treasury bonds are regarded as one of the safest investment options due to their backing by the full faith and credit of the U.S. government. Historically, countries such as Japan and China have been substantial purchasers of U.S. debt, utilizing these bonds as reserves and stabilizing their currencies. However, recent developments have altered this trajectory. These two major economic players have reduced their interest in acquiring U.S. debt. Why are Japan and China reducing their Treasury purchases? Several factors contribute to this decision. For Japan, the primary reason is the need to support its own economy. Japan has been grappling with low growth and an aging population, which have placed substantial pressure on its resources. In response, Japan's central bank has been actively purchasing Japanese government bonds to maintain low interest rates and stimulate domestic growth. This focus on domestic economic stability has reduced the availability of capital for acquiring U.S. Treasury bonds. China's reasons are equally multifaceted and complex. China's economy has experienced a slowdown, and tensions with the United States have escalated. There is a growing desire within China to reduce its reliance on the U.S. dollar, particularly in light of concerns about potential sanctions and geopolitical risks. By reducing its holdings of U.S. Treasury bonds, China is diversifying its foreign reserves, aiming to strengthen the renminbi and establish a more independent financial system that is less susceptible to U.S. influence. China's involvement in the BRICS alliance significantly influences its strategic approach. By joining BRICS, China aligns itself with a coalition dedicated to establishing alternatives to the U.S.-dominated financial system, including the potential for a novel reserve currency. This shift enables China to further its objectives of economic autonomy and support the BRICS agenda of de-dollarization. Consequently, China's withdrawal from U.S. Treasuries not only addresses domestic concerns, but also actively contributes to BRICS's efforts to construct a more equitable global economic order that reduces reliance on the U.S. Furthermore, it is not only foreign investors withdrawing from U.S. Treasuries that are causing a shift in the market. The U.S. Federal Reserve has also been scaling back its bond purchases. This adjustment is part of a broader strategy known as quantitative tightening, which we will elucidate in due course. However, prior to delving into quantitative tightening, it is essential to comprehend the concept of quantitative easing and its historical application. Quantitative easing, or QE, is a monetary policy tool employed by central banks such as the Federal Reserve. During periods of economic distress, the Fed may acquire substantial quantities of government bonds and other securities to inject liquidity into the economy. This process augments the money supply, lowers interest rates, and reduces borrowing costs, thereby stimulating economic growth. Quantitative easing was prominently utilized during the 2008 financial crisis and again during the COVID-19 pandemic, when the Fed acquired trillions of dollars in assets to mitigate the potential for a severe economic downturn. While QE can be beneficial in the short term, its implementation also increases the money supply, which can lead to inflation if employed excessively. In contrast, we have quantitative tightening, QT. Instead of purchasing bonds, the Federal Reserve permits them to roll off its balance sheet as they mature, effectively reducing the amount of money circulating in the economy. This action makes borrowing more expensive, intended to curb inflation and prevent economic overheating. The Fed's transition from quantitative easing, QE, to quantitative tightening, QT, is a response to the escalating inflation rates observed over the past few years. However, QT also diminishes demand for Treasury bonds. potentially necessitating the U.S. government to offer higher interest rates to attract alternative buyers. Elevated rates can render government debt financing more costly and potentially have a cascading effect on mortgage rates, credit card interest, and other forms of borrowing. When Japan, China, and the Federal Reserve simultaneously reduce their purchases of Treasury bonds, the U.S. Treasury must exert greater efforts to secure alternative buyers. This often entails raising interest rates to entice investors. While higher interest rates may appear advantageous to investors, they incur substantial costs for the U.S. government and can pose challenges for ordinary Americans by increasing loan, mortgage, and credit expenses. As interest costs rise, the U.S. government may find itself in a situation where a substantial portion of its budget is allocated towards debt servicing, rather than funding essential services or infrastructure. Over time, this could lead to higher taxes or reductions in government spending, affecting the entire population. Now, let us shift our focus to the BRICS countries: Brazil, Russia, India, China, and South Africa. This coalition has garnered attention for its endeavors to establish an alternative to the U.S. dollar as the world's reserve currency. Given the dominance of the dollar in global trade and finance for decades, a shift to another currency would be a monumental undertaking. The BRICS nations have proposed the creation of a novel currency, backed by a combination of commodities such as gold and energy. The primary objective of this initiative is to diminish their reliance on the U.S. dollar and fortify their domestic economies. By engaging in direct trade through this newly established currency, BRICS nations would mitigate their vulnerability to U.S. monetary policy and sanctions. The potential loss of the U.S. dollar's status as the world's reserve currency would have profound repercussions for the global economy, with significant implications for the United States. Reserve status entails the widespread utilization of the dollar in global transactions, facilitating the U.S. access to inexpensive borrowing. Should BRICS or other nations adopt a new currency, the demand for dollars would likely decline, potentially necessitating the U.S. to offer higher interest rates to attract buyers. In such a scenario, the United States could encounter elevated inflation, as imported goods would become more expensive. Furthermore, it may result in a diminished global standing for the U.S., as other nations would reduce their dependence on American financial institutions. While the BRICS proposal is ambitious, it faces numerous challenges. The establishment of a new currency necessitates not only trust, but also the development of the requisite infrastructure. For the present, the U.S. dollar remains the dominant currency, and BRICS nations would require a highly stable and widely accepted alternative. However, if BRICS nations continue to accumulate economic influence and advocate for de-dollarization, we may witness a gradual shift towards alternative currencies. The impact of this transition could be gradual, yet it holds the potential to reshape global finance in the long term. The global economic landscape is undergoing significant transformations, presenting the United States with new challenges. The decline in U.S. Treasury bond purchases by Japan, China, and the Federal Reserve, coupled with the potential introduction of an alternative reserve currency by BRICS nations, could lead to a turbulent economic environment for the United States. If you found this video informative, please consider liking it and subscribing for more comprehensive analyses of global finance and economics. Now we will cover the impact of Donald Trump's trade war, specifically with China, and how it could spiral into an economic collapse. From tariffs to retaliations, this is a complex issue with potential consequences for every consumer and business in the United States and around the globe. So let's break down the risks and explore how other countries might hit back. First things first, let's talk about tariffs. When Trump imposed tariffs on a range of Chinese goods, the idea was to make American companies more competitive by taxing foreign imports. Sounds good on the surface, right? But here's the catch. These tariffs actually raised prices on consumer goods in the U.S. because companies passed on those higher costs to consumers. For example, if a U.S. company imports electronics or machinery from China, they now have to pay extra tariffs, which makes those products more expensive in stores. And it's not just electronics. Think of items like furniture, clothing, and even food products. So in effect, the American consumer ends up paying the price. Now let's look at China's side of things. China holds over $1 trillion in U.S. Treasury bonds, making it one of America's largest creditors. Why does this matter? Well, if China decides to start selling off its U.S. debt holdings, it could destabilize the dollar and increase U.S. interest rates. This would make borrowing more expensive in the U.S., from government debt to mortgages. An increase in interest rates could lead to a slowdown in investments and spending, which are crucial for economic growth. In extreme cases, this could even spark a financial crisis, as a significant portion of the economy depends on stable interest rates and a strong dollar. Let's talk about how tariffs impact the cost of everyday goods. If American companies have to pay more to import products from China, they'll either have to increase prices or absorb the cost themselves, potentially hurting profits. The average U.S. consumer could see price increases on everything from smartphones to clothes and even household items. A recent study showed that consumers could be paying hundreds or even thousands more per year for the same goods they bought last year. For many families, this could stretch budgets even further. It's not just China the U.S. has to worry about. The BRICS nations, Brazil, Russia, India, China, and South Africa, are key players with strong economic power. If Trump's tariffs go beyond China, these nations could come together to retaliate, imposing their own tariffs or even cutting off U.S. access to critical resources. Imagine if these nations decided to raise tariffs on American goods in response. U.S. exporters could lose billions in key markets, or worse, they could make deals with each other to trade without the U.S., creating a parallel economic system where the dollar isn't the primary currency. All of this, higher consumer prices, interest rate hikes, and reduced export markets, paints a concerning picture for the U.S. economy. If companies are forced to cut costs, we could see layoffs, a decrease in wages, and ultimately, a recession. History shows that tariffs can lead to trade wars that destabilize economies, and we're seeing early signs of that now. So, could Trump's tariff war bring about an economic collapse? It's not inevitable, but the risks are real. Higher prices, potential retaliation from BRICS nations, and China's power over U.S. debt make this a fragile situation. Only time will tell if the benefits of these tariffs will outweigh the costs. Thanks for watching. If you found this video helpful, please give it a thumbs up and subscribe to our channel for more content like this. Let us know in the comments. Do you think the tariff war could collapse the economy, or do you believe it will ultimately benefit the U.S.? We'd love to hear your opinions.